start webinar again.
Did it hit start? Let me just check the. No, I need to make sure that I only share the. That I only share the. I need to make sure that I only share the presentation window, right? Cool. Thanks. Good morning. Okay, we've just opened it up, so we'll give it a couple of minutes for people to join. And just while we wait, if you're on Zoom, if you look at the bottom of the screen, there's a Q&A button there. Opens the Q&A panel. You can submit your questions as we go. If there are particular areas that you want covered, we can certainly try and incorporate that as we go as well. We'll just give it another minute or two. Okay, the people are still joining, so just give it another 30 seconds and then let's get into it. Okay, let's get going. Good morning, everybody. Welcome to day 2 of tax in the UAE. You would have all heard a lot, obviously, over the last couple of days about very recent legislation coming out right up to the wire, including yesterday. We have included some of that today. A bit of a frantic morning getting that into the materials to go through today, but we will be able to cover it. And thanks to those of you who weren't able to join the last one, for following up and asking for this one. We're obviously very happy to do it. So, purpose of today, it's very much a workshop format. I know there's been a lot of information put out there, or a lot of media that is talking about the legislation itself. I don't want to do too much of that. I really want to focus on the more practical aspects. So what do business owners actually have to do to be compliant? So what are the steps they need to take? What do they need to be thinking about? And how do we interpret the legislation as opposed to spending too much time on the legislation? Obviously, exception to that will be the new free zone laws that were released overnight. Bit of a sleepless night for some, but we'll cover that during the session as well, and then we'll get into some of the practical scenarios. Okay, so thanks, and by the way, thanks to those who also sent through questions ahead of time. We've tried to incorporate those into the session as well, into the materials as well. For those of you that are just joining, there is a Q&A section, sort of if you're on Zoom, where you can pop in your questions, and we'll try answer them as we go if they're not answered by in the course of running through the materials itself. Okay, let's get into it. So I will just quickly share the presentation. Bear with me, please. Okay, you should all be able to see that now. Let me know on the Q&A if you can't. Okay, so the most common question that I've been getting is, not actually when am I taxable, it's actually a step before that. So the most common question I've been getting is actually, when is my financial year? And so some clients almost seem almost embarrassed to ask that question, which is completely ridiculous, because for so many businesses in the UAE, they've never actually had to do any accounting, they've never had to do any financial reporting, aside from those that have to do VAT filing, for example, or have mandatory audit requirements. There's a huge number of businesses that have never had to do any financial reporting, and therefore they don't actually know when their financial year is. This is actually a very easy one to solve. So for the majority of you, your financial year will just be aligned to calendar year, so January to December. Most of the free zones do this by default. So they have rules where your first financial year, if you start in, say, March, your first financial year will run from March to December, and then every year following that, you'll go January to December, January to December, January to December. So for all of you that already have a company, your financial year will be aligning to January 1st, 2024. There are a couple of exceptions to this. the big one is for those of you that are registered in Dubai World Trade Center, DWTC. They don't follow that pattern. They have a slightly different approach. So they run it from the month that you register. So and then they run 12 months from that month. So you go 12 months from then, and then they keep that period going forward. So if you registered in, say, May 2020, then your first financial year goes from May 2020 through to April 2021, and then your next one is May 2021 to April 2022, and so you follow that that same pattern going forward. Very easy to work this out. If you have your memorandum of association or your articles of association, it's on the third or fourth page. This is again just for DWTC companies. If you go to the third or fourth year, it'll say fiscal year, and it'll tell you there where your financial year is. For those of you that are Virtue Zone clients, just send your relationship manager a note. They'll be able to check it very quickly. Again, just for Dubai World Trade Center clients, everyone else, you'll be, the vast majority of you will be aligned January to December. So that applies for Creative City, RACES, all of the major free zones. Okay. So if you know your financial year, the next question is, all right, well, when am I actually taxable, right? So when does tax apply to me? So the rule is, whilst yes, tax went live yesterday, it only actually applies for your first taxable year, your first financial year, which starts after the 1st of June. So for those of you that already have a company, set up, your first taxable year will be the one that starts on the 1st of January 2024. Right? Obviously, DWTC might be different, but for the majority of you, 1st of January 2024 is your first taxable year. Now, we'll cover what you need to have done before that point, before that stage. But your financial operations up until that point are not taxable, right? So that covers those of you that already have a company set up. The other group are people that are currently looking at setting up their company and they haven't formed it yet. Those of you who are forming a new company from now, you'll be taxable from the outset. So you'll be creating your company into a taxable environment. Your first financial year will start when you form the company, and you'll be starting that in the, within the tax regime. So when we're talking about the compliance steps here, they basically apply for you from day one. Okay, and again, if any of this is not making sense, then please pop your questions in the Q&A. Okay. So the compliance steps. There are 3 steps that are the same for pretty much every business. Well, the same for every business. So it doesn't matter if you are in a free zone, if you're in the mainland, if you have no activity, if you have clients all outside the UAE, none of that is relevant for your compliance steps in terms of the basic 3 steps. So every company is going to need to register for corporate tax. Every company is going to need to do proper accounting, and every company is going to have to file a tax return. Free zone companies, if they want to get the free zone exemption, the qualifying free zone exemption, they will also have to do an audit. We'll talk a bit more about that further down in the presentation. But every company will need to do at least those 3 steps. So the registration, the accounting, and the filing. Just quickly on those steps. So questions that we get around registration. You don't have to have a bank account to register. It's a question that we get a lot, but if you think of it this way, let's say you were a cash only business. The the tax man would still want his cut. So, you know, if you don't have a bank account, that's not an excuse to not be registering for corporate tax. Registrations are currently not open for free zone companies. The ministry was saying this morning that these will be open soon. Currently, it's only open for another couple of some other categories of company. So we expect those will be open very soon. I think there are still a couple of pieces of legislation for free zone, or legislation and guidance to be released for free zone companies, further to what was released yesterday, and so they're waiting for all of that to be released before they actually open up for registrations for free zone companies. Okay, the accounting. Sorry, I'm just going to quickly run through, check questions as we go as well. A DWTC company was registered in November 2022, so your first taxable year would start from November this year. So if you're a DWTC company and your financial year runs December to November each year, sorry, November to October each year, right? Then your current financial year, which you started in November last year, will finish in October this year, and then you'll start your next financial year on the 1st of November 2023. Because the start of that financial year is after today, or after the 1st of June, that means that your first taxable year starts on the 1st of November 2023. So it's the first financial year which starts after the 1st of June 2023. So Roman, I hope that explains it. Apologies, you're going to be taxable a couple of months earlier, but you know it's only really a timing thing. It probably wouldn't matter too much. There's another question here. Can the financial year be amended for a company that has already been trading? Look, you can't amend the financial year purely for the purpose of delaying tax. They made that quite clear in the legislation. You might amend the financial year dates if you have a commercial reason for it, or a compliance reason for it. So if you're part of a group of companies that all have different financial years, you might be able to align all of them, and that would change it. But you can't go and, I mean, the laws state that you can't go and just push out your financial year as late as possible to delay being taxable. Okay, the accounting side of things. So the ministry came out a couple of weeks ago with the guidance around accounting standards. So accounting needs to be done up to international financial reporting standards. That is a set, set rules. Smaller businesses are able to use international financial reporting standards for SMEs, which is a different set of standards. It's a little bit more lenient. Some companies are also able to use cash-based accounting. Now, that doesn't mean that you can just hand over your bank statements. You've got to still do a set of accounts, but you don't have to worry about certain things like accrued expenses or accrued revenue. But in all cases, you need to be doing accounting up to a recognized standard. So if you're not familiar of how to do this, it's very much advised to engage an accounting firm or an accounting service provider. Obviously, we do this at Virtuzone, and so it's the reason this is so important is because your taxable position will depend on what your financials are actually saying by the end of the year. So whether you qualify for for the small business relief, the free zone exemption, that will all depend on what your accounting says, so what your financial reporting says. Okay, and in terms of timing for that, so you do have to have an opening balance sheet. So let's say if you're taxable from the 1st of January 2024, you need to have accounting in place just up to that point, so that you can have a start point from which your accounting begins on the 1st of January 2024. This becomes especially important for free zone companies if they are looking for the free zone exemption, because auditors require a opening balance to validate the actual financials for the current year or for the 2024 year. Okay, then filing the tax return. So you will be filing a tax return after the end of your first taxable year. We get a few questions around, do I need to register for a certain type of exemption, or do I do this at the filing? So when we talk about the free zone exemption or the small business relief, what we know so far is that the registration process will be the same for everyone. And then when you come to filing, that is when you will declare for the free zone exemption or the small business relief or your taxable profit. And again, even if you are you're a free zone company or you're exempt, you'll always have to file the tax return to actually show the federal tax authority that that is your tax position. So unfortunately, you can't just sit back and go, I'm a free zone company, I don't need to do anything. Actually, it's the other way around. A free zone company actually has a little bit more of a administrative task to go through. Okay, let's get this to the next slide. All right, so I just want to talk about the three main exemptions or relief rules that would apply to small businesses and small medium businesses. So I like to think of this as layers of insulation around whether you have to pay corporate tax. I think at this point it's worth looking at why corporate tax is being introduced here in the UAE. You've probably heard it said a lot, but this is very much a macro level decision. So the UAE wants to be seen as a fair player in the world economy. So they are abiding to this, or they are looking to comply with this idea of a minimum worldwide tax rate. So you'll see that this is very much aimed at large multinationals to avoid them shifting their profits into low tax areas like the UAE previously. This is not aimed at small and medium businesses. It's not a revenue gathering exercise to get as much money out of small and medium and micro businesses. It's actually quite the opposite. So the legislation does seem to have very wide exemptions, or it's very fair on the smaller businesses, and they've come out and said very clearly that they don't want this tax to disrupt that sector of the economy. And so the upshot of that is that you have these exemptions available or relief rules available. Each of them have pretty clear rules around them, and there is actually scenarios where you may not qualify for one, but you're able to go for another, or you might have a choice as to which one you want to go for, and there are various factors that might contribute to that. But let's just talk about it at a high level. I'll cover small business relief and tax-free first, because qualifying free zone, I know that de minimis is a bit of a confusing term to have there. It's not a spelling mistake, it's what they've said in the legislation, but we'll get to that. So if you qualify as a free zone person, you won't have to pay tax, okay? When I say qualify as a free zone person, the ministry has now released a definition of qualifying free zone person and what is qualifying free zone income. We'll cover that next, but if you do meet that qualification, you won't be paying tax. If you don't meet that qualification and you are treated as a taxable person, the next relief, or the next layer of relief that you would be looking at, is the small business relief. Now, that is a revenue threshold, right? And that looks at so your total revenue for the year. If that was less than 3 million dirhams, then you'll be exempt from paying tax. again, in all of these scenarios, you still need to go through the steps of registration, accounting, and filing a return, because you need to actually show, or you need to prove to the federal tax authority that you meet these thresholds or these exemptions. Now, let's say you don't meet the criteria for the qualifying free zone exemption. If you have revenue of more than 3 million dirham, only at that point would you be an actual taxable business and looking at paying tax. But even then, it's only if your profit, so your profit, not your revenue, if your profit was more than 375,000 dirhams for the year. So the way it works is you pay 0% tax on the first 375,000, and then you pay 9% on everything over that. But again, you only get to that point if you don't meet the criteria for a qualifying free zone person. If you don't meet the criteria for the small business relief, only at that point are you actually paying tax. And that's when you would be looking at things around, legally, ways to reduce your taxable profit. And that, that may be as simple as correctly classifying expenses, and there are a few other measures as well, which we'll cover towards the end. Okay. All right, the free zone criteria. Now, this is what was released last night. So this is the one that everyone has been sort of waiting for. There were a few sort of ways that the ministry, or a few roads that the ministry could have gone down. What they've confirmed last night is that to be a qualifying free zone person, there are requirements. So obviously you've got to be registered in a free zone. You do have to meet the economic substance requirements. And what they've said last night is that you have to derive 95% of your total revenue, and sorry, this says income, but it's very clear it means revenue. 95% of your revenue has to be qualifying revenue. Now, we'll explain what that is. And then you can have up to, which that means is that you can have up to 5% of non-qualifying income. This is why they have stated that free zone companies will require an audit to qualify for this exemption, right? Because you will need an auditor to check this. But first point to make is that it's not a case of one client in the mainland and you're disqualified. That's not the case. It's not a case of paying tax on the portion of your revenue from within the mainland. They've said, as long as you only get 5% of your revenue from the mainland or from excluded activities, then you meet the free zone exemption. Then you get the free zone exemption. Okay. We'll get to economic substance in a second. I just want to talk about these new rules around the free zone exemption. So, what is qualifying income and what is non-qualifying income? So there are two views. There are two criteria for this one. So first one I want to talk about is the geography criteria, right? So what they have confirmed yesterday is that you can derive revenue, or you can earn revenue from other companies in other free zones, and that doesn't disqualify you. So getting revenue from within the mainland is what counts towards your 5% limit. But revenue earned from other free zone companies or companies in other free zones or your own free zone, you can trade with them, and that is considered qualifying income, which is great. There was concern that it was only going to be allowed. They were only going to allow revenue within your own free zone, or there was going to be different treatment of free zones. But they've confirmed yesterday that revenue is allowed from other free zone companies. Revenue from outside the free zone, so mainland revenue, that counts towards your 5% limit, right? Your 5% excluded limit, unless it's what's called a qualifying activity. So this is the other criteria. So one of the criteria looks at the geography. The other criteria looks at the activities. Now, I know that there is, clearly you can see we've just completely copied this out of the legislation. So it's an extensive list, right? And it'll be quite unique to various businesses. This will be, I'll make sure I send around these slides so you can have a look. But the main point here, right, is think of the geography. If you're only trading within free zones and you are not doing one of the excluded activities, which is listed on the right, and I think the majority of our clients here at VirtuZone wouldn't actually be doing any of these excluded activities, with the exception being sales to individuals is excluded, which is understandable because a individual person doesn't have a registration in a free zone, right? Well, in most cases doesn't. So they say a transaction with a natural person, that's excluded. So B2C transactions are excluded. But other than that, if you are a company just trading in the free zones, then in most cases you'll qualify for that will be qualifying income. Let's jump to what this means. So the same rules apply, right? So the same 5% limit. So if you were looking purely at the activities criteria, you can earn up to 5% of your revenue from the excluded activities, and the 95% has to come from qualifying activities. Now, there's clearly a intersect here, right? So there's the geography and there's the activities. And so how does this all look when you put it together? So 95% of your revenue has to either come from free zone companies or from qualifying activities. A lot of the cases it's going to be both. And then, so at least 95%, which obviously means that 5% of your revenue can come from outside the free zones or from excluded activities. This, I know, is a little bit complex. I can see questions coming in already. And it is the biggest question that this has raised for a lot of us. I've had messages through the night about this next piece, which is, what about revenue from outside the UAE? Now, the legislation does not say a word about this right now. And so I think when they are talking about, and this is speculation here, but in the absence of any guidance in the legislation right now, I expect that they will clarify this in the coming days before they open up the registrations for free zones. All of the consultation documents discussed this up until this point, and the fact that it is not directly addressed in any of the legislation, we're really hoping that means that they will do a confirmation around that treatment. Because as it reads right now, they are saying that qualifying income has to be within the free zones, right? And so therefore, income coming or revenue coming from outside the free zones, whether it be from the mainland or from abroad, would be excluded. Now, until we actually see a clarification on that or a guidance note around that, I'm going to hold out some hope that that is going to be qualified. So that's very much a TBC in my view. Okay. What happens if you are registered in a free zone and you breach the rules, right? So whether it be intentionally or you don't qualify for some reason, right? So let's say that you are a free zone company and 40% of your clients are inside the mainland, so inside the UAE. So that means that 60% of your revenue is qualifying revenue, 40% is not. So you've clearly breached the 5% cap. What that means is obviously you don't qualify that year and you lose the ability to qualify for the following 4 years. So you have a 5-year sort of exclusion period from qualifying again. And during that period, you are treated as a regular taxable person, right? Now, when that applies, that is when you would be, and we'll talk about this in some scenarios here. If that applies to you, so you're no longer a qualifying free zone person, you still have the options such as small business relief available because you were treated as a regular person, a regular taxable company. And you will also have, obviously the tax-free threshold as well will be available to you. So if your revenue was 3.5 million, the tax-free threshold will still be available to you. Okay, let's quickly touch on economic substance requirements. So ESR is it's basically a measure that it's tax related, and it's a measure that the UAE government has in place. It's been here for a number of years, and it basically ensures that people are not just shifting profits from high tax jurisdictions into low tax jurisdictions. And the way it does that is make sure that you are actually conducting a business here in the UAE. It only looks at certain what's called relevant activities, and there is crossover with the relevant activities that are listed in ESR and the excluded and included activities in the tax legislation. But for ESR, it's to stop people doing things like moving a intangible, like a logo, for example, or a trademark, putting ownership of that trademark into a UAE company, and then charging their related party overseas for use of that trademark, so that it shifts. It decreases the profit of that company overseas, moves the profit into the UAE where there was no tax. That is what economic substance rules are there to prevent. If you're not sure about whether you meet the ESR requirements, then it's probably something that you need to look at. You probably need to be aware of the relevant activities as a start point, and it's obviously something that we offer here at VirtuZone as well. Okay, now just quickly some of the pros and cons about the free zone exemption. So the free zone exemption, they've said, will go as long as the free zones have committed to tax free. So I think it's 50 years tax free, which is significant because the small business relief, which we'll talk about next, only goes until 2026. And so we are saying if you have both options available, it's more important to maintain your free zone exemption, right? Because if you lose your free zone exemption, you can't, now they've confirmed you're out for 5 years. So you'd be taxable beyond 2026 if you were going for the small business relief. So come 2027, you'd be taxable, and you'd have to wait a couple of years before you go back to the free zone relief. We'll go through that in a second. The cons, it's the additional compliance. So you'd need to undergo an audit to qualify for the free zone exemption. For some companies, a lot smaller companies, they might be looking at this going, well, I'm never going to be taxable under the profit threshold. So, and if I'm treated as a taxable person, so I'm not going to worry about spending the extra 5,000 to 10,000 dirham on an audit, because I'm not going to be taxable anymore. So, there are some areas where there's a crossover or there's a decision to make. We'll go through some scenarios to illustrate those as well. We'll quickly run through the small business relief. So this applies for taxable companies. So it's not available to qualifying free zone companies. So you can't have both. So better way of thinking about it is if you are a free zone company and you don't qualify for the free zone exemption, then you're treated as a taxable person, and therefore the small business relief will be available to you. But they've clearly stated that small business relief is not available to qualifying free zone companies. It doesn't require an audit, so it's a lot simpler to comply with. But the issues are that it's only here until 2026. And so beyond that, if your revenue is more than 3 million dirhams, then you become taxable, or, well, unless they extend the rule, but I wouldn't be relying on that. And the other issue is that if you go for the small business relief, you can't carry your losses forward. So we'll go through some scenarios where you might actually not even opt for the small business relief. And then the third category is a taxable business. So this is what we were discussing. This is the one that you've probably heard a lot about, which is 0% on the first 375,000 dirhams of profit. And this is when you are looking at, what is a tax efficient financial flow or operating structure. Thinking about things such as, and this is a question that we get a lot, which is, if I'm taxable, can I just pay myself a huge salary, right? As if I'm the owner. The answer to that is any payments to a connected person, so be that yourself, be that relatives, it has to be market value or arm's length. So the way you think of this is, if I went out and hired someone unrelated, right, what would they be earning in the same position? And it's got to be relatively similar to that. So you can't really just, if you've got 4 million dirhams of revenue and you're a mainland company, you can't go and pay yourself 4 million dirhams of salary unless you can actually justify that. And neither can you hire your wife and your 2 kids and pay them each 1 million dirhams. It's got to be market value, and the FTA will certainly be looking out for people reducing their taxable profit through or attempting to through channels such as that. Losses, the key thing, and we'll discuss this about whether you go for small business relief or not, is that losses can be carried forward. Okay, give me 1 second. Yeah, a lot of questions here asking about the about revenue source from outside the UAE. So I think we are really waiting for proper clarification on that. Okay, so I might actually skip through the free zone one because it's so I just want to jump through here. Okay, so we'll just jump to a couple of scenarios, the ones I've kind of referred to. So we've talked about how a free zone company might qualify for the free zone qualify for the free zone exemption. We've talked about a small business that might qualify for the small business exemption. But what about when there is an option, right? Or when do you need to consider not going for one of the exemptions? So let's say you are a company who doesn't qualify for the free zone exemption, or you're a mainland company, you have revenue of 500,000 a year, and you're making a loss of 300,000 dirham. Now, this might apply if you are, for example, if it's your first year and you've just started up and you've got all large outlays, for example. In a case like this, you might not go for the free zone for the small business relief, because the small business relief, you can't carry forward that 300,000 loss, right? So you would elect to be a normal taxable person. You wouldn't go for the small business relief, especially if next year you expect to be profitable, because you want to carry forward the loss to offset that profit next year so that you don't have to pay tax, right? So, and this is where, this is one of the cases where you probably wouldn't want to qualify for that. You want to go for the small business relief. I actually haven't updated the slide for the new rules from last night, but let's say you are a free zone company, you've got 500,000 of revenue per year, all revenue, ignore outside the UAE because we don't know that yet, but let's say all revenue is coming from other free zones and it's all qualifying activities. So you qualify and you meet the ESR requirements, right? this is where you might be looking at this going, well, if my revenue is $500,000, I can probably, through paying myself a reasonable salary, my profit's going to be less than 375,000. And this is where you're making that decision of, all right, do I really want to go through the process of doing an audit and paying for an audit every year to maintain my free zone exemption if I don't think my profit's ever going to go over 375,000? Now, you're going to qualify for if you opt out of the free zone exemption, you're going to qualify for the small business relief, at least for the next few years. And then assuming that your activities stay at the same level, you're not going to be paying any tax if your profit, is down below 375,000. So you have a decision to make, right? Which is, do I go through this process of maintaining my free zone exemption, or do I just opt out in the knowledge that I'll never actually be paying tax and save myself having to do an audit? The reason you might maintain the free zone exemption is if you expect to grow, right? So if you made 500,000 this year, but you expect that to grow to 1 million, 2 million, 4 million, 5 million, right? Then it is absolutely going to be in your interests to maintain your free zone exemption. Keeping in mind that if you lose that, or if you opt out, you can't come back in for another 4 years, right? So there is a scenario whereby if you are growing and you've already opted out, beyond 2026, you're going to be taxable. The small business relief is gone, and you're going to be waiting to be able to opt back in or to qualify again. And so, by saving yourself a bit of money, or 5,000 to 10,000 dirhams a year on your audit, you're actually got a much larger tax bill. Can a company, just looking at some questions, can a company change its decision whether to be taxable or to enjoy tax reliefs? Not when it comes to the free zone exemption. So they've said that it is a irrevocable decision, right? So if you decide not to go for the free zone exemption and elect to be a taxable person, then you can't change your mind the following year. But the way that I read the legislation is that once you opt out, you're out for 5 years, which is fair enough, because otherwise people would be jumping back and forth, depending on what suits them and when. Okay, let's jump to and apologies in the frantic updating the new slides for the free zone legislation that came out last night. We haven't updated this slide. So this is a scenario. Say you're a free zone company, right? You've got 5 million dirham of revenue. Okay, so you wouldn't qualify for the small business relief if you opted in for that. And let's say that this is the situation we were talking about before. Let's say 7% of your revenue comes from the mainland, right? And 93% of your revenue comes from within free zones. This is where you will be making this decision around, all right, well, how much revenue, knowing that you need to get your onshore revenue down to 5% each year, how much revenue would you be willing to give up from the mainland to remain tax-free, right, to qualify for the small business relief? And this is actually going to be, it's a mathematical question, right, a basic mathematical question, and it's one that people are going to be facing, where they will be saying, is it in my interest to offboard some clients purely, to ensure that I remain under that 5% threshold? And what that'll be is, you'll be looking at your client base, what your tax would be if you lost the exemption, and it may be, I think there will be cases where people, end client relationships so that they can remain a tax-free qualifying free zone entity. Okay. And we'll go one last scenario. Okay, so this is where we have a fully taxable business, right? So you're a mainland company, you've got 5 million of revenue per year, so you don't qualify for the small business relief. You're making 4 million of profit. So this is when you are a genuine taxable business. This is when we start looking at ways to minimize your taxable profit within the rules of the tax legislation. So this is when we are looking at, owners paying themselves salary, a reasonable salary. There are, when we get to the sort of upper end of this, so let's say you have a consulting business, it's 1 or 2 people, you pay, currently you might pay yourself all the money that comes in, you pay out, right? We might have, you may have a scenario where you need to do like a benchmarking exercise to say, all right, what would a partner in a consulting firm be earning, right? And there's a few ways you can do this. We've been doing it for clients by looking at publicly available information or getting information or doing research exercises to actually develop a benchmarking table of salaries and saying, all right, this is a reasonable salary to pay yourself out of your business that shouldn't cause issues with the federal tax authority. Sometimes it wouldn't come to that, if it's a smaller salary and you know that it stacks up as reasonable in the industry, then you might not require a full benchmarking exercise. It'll differ by, the needs will differ by business. Other things you might be looking at doing is instead of, if you were about to inject more capital into the business, you might elect to do that by a loan to the business instead, thereby charging interest on that loan to the business, which is a deductible expense for the business, so that reduces your taxable profit. There are caps on that, but it is a legitimate and it's a very common method of company funding around the world. And specifically, the tax legislation has put a cap on it, and the acknowledgement that this does happen, that related companies or connected persons will make loans to their company or to their business and charge that business interest. The other thing to be considering is that expenses for entertainment will only be deductible at 50%. So if you go out for lunch, take a bunch of clients out for lunch, then you can only claim half of that off your taxable profit. This is where it gets quite important to categorize your expenses correctly. If the FTA were to ever look at your accounts, and let's say you just chucked a whole lot of stuff into other expenses, and the FTA looks at it and all of your entertainment, your lunch expenses and everything are bundled into that. What we see in audits in other jurisdictions like Saudi or Qatar is that they would just go, okay, no, we can't go through and identify all of this. We're just going to disallow 50% of it. So it's quite important that you have your accounting in line so that you can separate out what is genuinely fully deductible, structure so that you have you are really benefiting from the rules that are allowed for deductible expenses, and also minimizing the risk that you will be found to, minimizing the risk for audit issues if the FTA were to look at your accounts and test your accounts. Okay, there are a few questions coming through. Yeah, well, the webinar recording will be available. 50% entertainment expenses, copy paste of the US, yeah, copy paste of a few countries, New Zealand and Australia as well. Okay, I'll quickly run through these, see if there are some common themes. Question that we get a little bit is around, again, back on the owner salary piece, is can I put my villa, my apartment, my car through the business? Look, the main rule is that an expense is deductible for the business if it relates to generating the revenue of the business. If you were to put something personal through, so a car that is for personal use or your personal apartment, that wouldn't be looked at as a expense of the business. That would be looked at as the remuneration of the owner, right? Or remuneration of whoever that is being provided to. And so if we think to that reasonableness or that market value, if you're paying someone 30,000 dirham a month and you're also providing them a car and an apartment, then their remuneration or their total remuneration will be looked at as the monetary value of all of that, and that is what will be tested for market value. So, putting your own apartment and your own car into the business is only really doable if the total value of all of that is reasonable. Market value, the same as someone unrelated was doing the same thing in your business. Okay, I'll just quickly jump through some others. Yep, slides will be available. The legislation, you can go to the Ministry of Finance website and go to the legislation section. Don't go to the FTA doesn't really list the legislation. They have links to it, but go to the Ministry of Finance website. Okay. Great. So I think we might end it there. There are a few more questions coming through. Very happy to answer questions if you want to send them through over email. If you have, or even better, if you want to try our AI tax assistant, go to asktaxgpt.ae. It's really, really good. We're going to be training it up on the new free zone legislations today. If you want to have any help around your registrations, or you need to get your bookkeeping done and your accounting, obviously VirtuZone, we offer all of these services. Go to taxready.ae. You can download the guide on corporate tax, and you can get in touch if you'd like us to help you out with any of your mandatory requirements. So thank you very much everyone for joining. Hopefully we get a little bit more clarity around that offshore income for free zones. Please reach out to me directly. I think you'll probably have my email address on the materials for any other questions that you have. Very happy to help, and we'll hopefully talk soon. Thanks.